Hey guys, this is Mike. This is going to be an introduction video to Fibonacci retracements and how to use it, and a little bit of information on confluence using Fibonacci retracement. So the first important thing when using the Fibonacci retracement is to understand exactly what is a Fibonacci retracement. And basically, Fibonacci retracement are Fibonacci numbers that represent how much the market has retraced. So the idea behind these numbers are that these are levels at which traders would look at and can become important levels to watch. So the most popular ones are the 23.6, 38.2, 50%, and 61.8%. A lot of people tell you that 50% is not actually a Fibonacci number, but nevertheless, it is included in most Fibonacci retracement tools and is probably the most popular of all the Fibonacci numbers. So let's get into how to apply this to our chart. The first thing we need to do is identify swing high and swing low. So if you haven't watched my video on how to identify a swing high and a swing low, I suggest you do that before watching this video, because it'll really help you in placing the Fibonacci retracement tool. So first we're just looking at the USD JPY, and I'm just going to mark some swing high and swing low points. So we have a swing low, a swing high, a swing low, a minor swing high, a swing low, and the start of another swing high. So what can we do with this using the Fibonacci tool? Well, if we plot the Fibonacci tool, the idea is we're looking for the current move to retrace. So if we used this swing high up here and this swing low here, we would take the tool and we would apply it from top left to bottom right. So this would give us the retracement we're looking for to go with the downtrend. So if the trend is down and we put in a swing low, what we're looking for is the market to retrace up to one of these Fibonacci lines and continue on. So if we see here, we plotted it from the top to the bottom of this swing low. We can see the market went right to the 38.2 before reversing and continuing on. So using the Fibonacci tools, you could either use them to place orders to sell right at these areas, or you could use price action to confirm this. So if we zoomed in here and we see, okay, price came down, we formed a low, and as price started to move up to about here, we would be able to plot a Fibonacci retracement, and we would say to ourselves, okay, of this large move here, I want to see if there's price action on any of these retracement levels. And as you can see, price moved to the 23.6 and bounced a little bit, and then when it reached the 38.2, it pretty much stopped dead on its tracks before continuing on. And if we look here, we got a bunch of bar highs, a bunch of inside bars that could have all gave us triggers to get into the market. Now, if we go and we look at this next move here, where price came down, we could do the same thing again. We could use this swing high, which would be here, and this swing low here. So if let me just move this here. So now we would do the same thing. We would plot from the top left to the bottom right. So that way the 100 level would be right at the top and the 0 would be at the bottom. And again, we could look to these levels to give us an idea of where we could enter the market. And if you could see, price came up, passed right through the 23.6. It stopped momentarily at 38.2 before bouncing down, came up again, stopped at the 50 about before coming down again, and now it looks like it's coming up to retest maybe all the way at the 61.8. So as a trader, you would look to possibly look for price action around the 61.8 now to get us back into the downtrend. So the idea is to use this tool in relationship with other tools such as price action or support and resistance to help us find areas to look for price action. Okay, now I want to talk about how to use multiple swing highs to find confluence. So if we look at the same chart, besides plotting a Fibonacci retracement from this swing high to this swing low, we can also plot one from this swing high to all the way to this swing low. So if we do that, it would look something like this. So now if you look, this Fibonacci retracement is this whole move, whereas this Fibonacci retracement is just this move. So just one more time, the Fibonacci we plotted from here to here is looking at this whole move as a retracement. So if this whole move, where we were going to retrace to, we have each of the different levels of that Fibonacci. And we also leave the Fibonacci retracement of this smaller move. So now what we do to look for areas of confluence, which would be where multiple Fibonacci retracement line up. So if you look here, we had the 23.6 and the 38.2 line up on each other. So if you see, right when price reached this level, this was a good area of confluence to look for a possible retracement entry. And as you can see, price did bounce here. Next, if you see, the closest thing we have is the 38.2 and the 61.8 lining up. So this area here would be a good level of confluence. So what a lot of people like to do is basically, after you draw these Fibonacci tools, you could just mark these areas so that when price reaches these different areas, you'll notice on your chart already that you should be aware of them and possibly look out for price action. Okay, so I'm just going to go ahead and get rid of everything here. And I'm just going to pull up another chart so we can look at something else. So I'm just going to go ahead and pull up the euro. Okay, so let's say we look at the euro. Let's say we look at the euro weekly chart. Okay. That's not a great example. Let's look at the euro daily chart. Let me just zoom out a little bit. Okay, again, the first thing you want to do is identify swing high and swing lows. So looking at this chart, we have all types of swing high and swing lows, as I talk about in my other videos. We have major swing highs and minor swing highs, minor swing lows and major swing lows. So looking at this chart, you can see we have a swing low here, a swing high here, a swing high here, and this would also be a swing low. So if I was drawing my Fibonacci, I would connect swing low to swing high, and then look at these areas for retracement. Now, a lot of people ask me, when you have another swing low so close, which one do you use? Well, when it's that close, I usually like to use the most recent swing low, but a lot of people like to put it at the other one. So that's really up to you. So you could really use either one. The idea is just to get an idea of where the market is putting in these retracements. So let's say we kept it at this most recent one. Well, after this top forms here, we don't know that this is a swing high until we get to about here. So by the time it reaches a 23.6, that's pretty much when I would identify this as a swing high. So I don't really use that level much. But if you look at the 38.2 now, if you look, price came up, retraced to the 38.2 before continuing on again. So again, this is a case where we could look to these levels for price action somewhere along here to get us back into the trend. So if we zoom in now and we look at the price bars at this level, well, look what we got. Initially, price came down here. We had an inside bar here that didn't break up. Then we had a little bit of a bearish outside bar, not the best one. This did break up for a lot of pips. And we had nearly another inside bar here that broke up. So let's say you didn't get in anything here. There was nothing that really piqued your interest. Well, if you look, price came up, came back down again retested this 38.2 Fibonacci level, along with this support now of these price bars. And look what we got. We got a big bullish outside bar. And as you can see, this bar triggered, and if you were able to stay in, this thing has gone, skyrocketed up, and that would be an amazing trade. So the idea of these Fibonacci retracements is to find levels that could potentially be places to look for price action. Now, let's say price stalls right here and starts to trickle down. Well, this is a case now where you could have multiple Fibonacci retracements. You could have one from this swing low to this swing high, and now this area is a swing low, and this area would be a swing high. So if we deleted this one and we redrew them, it would be like this. We would have one from here to the top, and then we could also draw one from here to the very top also. So now if you look what happened, this is where you get confluence, where things line up, where multiple things line up. So if you look, we see the 23.6 and the 38.2 are pretty much perfectly lined up, and the 38.2 and the 61.8 are perfectly lined up. So if price now starts to come down, and this is the top, which we don't know yet, this would be the first area to look for a good price action trade to go back long. An even better area would be if we got all the way down to here. And the reason this is an even better area is because look, along with the 38.2 and the 61.8, we have all these bar highs here. So this previous resistance we would now look to turn into support. And along with the Fibonacci retracement levels would be an awesome area to look for the price action bars that James teaches. So this was just an introduction to Fibonacci retracement tool. There is some discretion alongside plotting these, but for the most part, if you look for the obvious swing high and swing lows, it makes things a lot easier. So the higher the time frame, the easier these usually are to plot. Now if you go down to the hourly time frame, let's say, you're going to have all kinds of possible Fibonacci retracements because there's a lot more swing highs and swing lows. So for example, you might use this as a swing high and this as a swing low, or even this as a swing low. So if you plotted this tool, you went like this, so you would be looking at these areas to possibly go back short again. But now, since we're on the hourly chart, there's a lot more noise. So when price finally starts to go up, you have a swing low here, a swing high here, swing low here, a swing high here. So you're going to be plotting this tool more often, and there's going to be a lot more false signals. So initially, when you're getting used to this, stick to the daily and the weekly time frames. It's the easiest way to plot these, and they're very reliable along with price action.